Higher rates, higher yields, what is that telling us about the economic recovery? And could the Fed be forced to hike rates sooner than many out there are anticipating, particularly when we have this tailwind of a lot more stimulus?
Well, I think that is the market possibly getting over its skis and being presumptuous. If anything, there is a little bit of jubilation in the market because there is this commitment on the part of the Federal Reserve that if the 10-year yield, if the benchmark 10-year yield was to get to a certain level, a lot of investors call that 1.35, 1.50, that yield curve control would be imposed. And I think that would be a lot more interesting for the markets come January the 27th, the Fed's first meeting for 2021, with a more dovish composition to the Federal Open Market Committee. We had some hawkish members fall off of the voting rotation. So I think that markets would be much more interested in seeing yields rise to a high enough level to bring the Fed off the sidelines. We don't realize that other than quantitative easing, because the credit facilities were not used to a great extent, that it really has been some time since Jay Powell has really taken any action in terms of monetary policy to bring yields down. So I think investors, again, are prematurely getting ahead of themselves, anticipating the Fed beginning to tighten when they're not even thinking about taking such measures.
And Danielle, it's interesting because the Fed has said that 2023 could be the time frame for when we could see a hike in rates. But if we did see growth accelerating in the second half and good progress on the vaccine execution, don't you think that there might be some merit in deciding to lift rates off these emergency lows?
Well, so I'm a 9-year veteran of the Federal Reserve, and monetary policy tends to move in a process. And so we've heard rumblings out of the Fed that a few of the district presidents saying that they could be contemplating tapering later on. And that would be a first step, would be to start to curtail the $120 billion per month run rate of quantitative easing as it is today. And that would be a step that they would take prior to any tightening measures. And certainly they would get to the point where they would fully taper, at least if past is precedent, before they were discussing actually increasing interest rates. Again, the Federal Reserve's own forecasts don't put the inflation target even at the 2% rate all the way out to the end of 2023, given their latest projections.